Why should you care about market principles? Whether you're new to trading or you've been around for a while, understanding how markets work is essential. If you have ever wondered why prices go up and down or how to predict market trends, this video will help you crack the basics. By the end, you will know the market exists, how they function, and how you can use this knowledge to make smarter trading decisions. Markets run on two basic principles, and understanding these can help you avoid costly mistakes. First, here's an equation to grasp how the market works. Price plus time equals value. This applies to any market, helping you figure out if something is overpriced or underpriced. The second principle is about your personal success. The better you understand the market, the better your results. Your knowledge and strategy directly impact your trading outcomes. And if you have some knowledge, this principle will fill in the gaps and deepen your understanding of how the market satisfies the needs of buyers and sellers. To really get why the market exists and how it works, let's compare a situation before a true market even exists. Imagine two people, each with something the other wants, but with no centralized place to trade. They may still make a deal, one person selling a product to another, but without enough information, the trade isn't optimal. That's where markets come in. By centralizing trade, they provide the information needed to make better, more informed decisions. For buyers, it's hard to know if a product is worth its price without an option to compare. They may overpay due to lack of competition. For producers, they need to set the right price to maximize profit, but without a market, they lack key information on consumer demand. So if you're still with me, hit that comment button and let me know if you have ever overpaid for something without knowing the market price. No judgment, we're open there. Even if buyers and sellers agree on a price, it's not as effective as a real market where trade can increase. A market connects people efficiently, benefiting both sides. Producers sell more and consumers pay less, with competition improving quality. Markets must meet the needs of participants to survive. They require competition, active participants, and place to trade. In a major market like auction houses, goods are exchanged based on the past transaction data, helping buyers and sellers set fair expectations. A market thrives when it's well organized and information flows smoothly. Markets have four components: product, producer interests, consumer needs, and time. Producers aim for profit while consumers seek value. The goal is for both sides to meet their needs as efficiently as possible. Price is the heartbeat of any market, right? It's what makes buyers and sellers agree on a deal. Price isn't fixed. It moves, shifts, and balances the market to keep things fair. But when it's too high or too low, it messes up the balance. Ever tried buying a shirt on a clearance for $25 when it used to cost $50? It's a sweet deal, but stores won't go too low. They still need to make a profit. Similarly, hotel rooms near an amusement park can charge top dollar until competitors step in. Too much supply, prices drop. But here's the twist: if prices stay too high, market activity drops. If they're too low, you risk losses. So the market loves balance, prices that attract both buyers and sellers. Time also plays a huge role in this. It helps set the stage for price changes and keeps things in check. Short-term trades react fast to price swings, while long-term investors move slower, but they still impact the market. Ever notice how grocery shoppers grab what they need now, but only the rare few hunt for future deals? Prices shift when these short-term and long-term players are in play. The market isn't just about the product, it's about when, where, and how quickly people act. And trust me, if you can predict the timing, you will be ahead of game. Who is ready for that challenge? Don't forget to like this video. Unless you think time is money, then you probably just saved yourself a click. Want to understand the market? Pay attention to players with different time horizons and how they react. When prices trade too far from a product's real value, long-term investors jump in, buying low or selling high. But what happens when prices stay close to the real value? In this case, the market keeps moving along without much change, and the new price becomes the norm. Over time, some markets trend up or down. For example, housing prices often rise because demand is steady, while long-term owners aren't eager to sell. On the flip side, markets tied to economic shifts like oil can change quickly. Prices spike, production rises, but consumption drops, leading to corrections. In the end, the market's job is simple: to make trade easier for both buyers and sellers. Without it, buyers might overpay and sellers wouldn't know how to adjust prices to maximize profits. The market solves these problems, creating balance and opportunities for both sides. So, is your trade on track, or is the market ready to set things straight? These are basic principles that, in our opinion, every trader should have in mind. Without them, the market turns into just numbers on a screen, cold charts with no real meaning. But the truth is, behind every price move are real people, real goods, and real money. Keep that in mind the next time you trade. We truly hope this video helped you see the market from a deeper perspective. If you found it useful, hit that like button and subscribe for more insights on trading. Wishing you successful trades and see you next time.